Hello everyone, this is your teacher Anne. The main takeaway of this video will be the conceptual framework of performance management. Before anything else, please make sure to have your pen and paper with you so you could take down notes as we move along the discussion. Pause the video and resume when ready. The conceptual framework of performance management has the following subtopics: the concepts and components of performance management, definitions of performance, productivity, and efficiency, and their distinctions as well, a quick review of financial performance analysis, supply chain management, customer relationship management, and lastly, customer profitability analysis. This is part two of a two-part video, and this covers the last three topics. Let's get started with supply chain management. Supply chain management encompasses the planning and management of all activities involved in sourcing, procurement, conversion, and logistics management services or activities. Importantly, it also includes coordination and collaboration with channel partners, which can be suppliers, intermediaries, third party service providers, and customers. So, in essence, supply chain management integrates supply and demand management within and across companies. In a typical supply chain, raw materials are procured and items are produced at one or more factories, then shipped to warehouses for intermediate storage, and then shipped to retailers or customers. Consequently, to reduce cost and improve service levels, effective supply chain strategies must take into account the interactions at the various levels in the supply chain. The supply chain, which is also referred to as the logistic network, consists of the following chains. You have your suppliers, manufacturing centers, warehouses, distribution centers, and retail outlets. Thus, we can define the supply chain management as follows. Supply chain management is a set of approaches utilized to efficiently integrate suppliers, manufacturers, warehouses, and stores so that merchandise is produced and distributed at the right quantities, to the right locations, and at the right time in order to minimize system wide costs while satisfying service level requirements. Now that we have an idea of what supply chain management is, we can already answer the question: what are the objectives of supply chain management? Supply chain management must take into consideration every facility that has an impact on cost and plays a role in making the product conform to customer requirements, from supplier and manufacturing facilities through warehouses and distribution centers up to the retailers and stores. Second, it must be efficient and cost effective across the entire system. Total system wide costs from transportation and distribution to inventories of raw materials, work in process, and finished goods are to be minimized. Third, it must revolve around efficient integration of suppliers, manufacturers, warehouses, and stores. So, meaning it encompasses the firm's activities at many levels, from the strategic level through the tactical and then to the operational level. Let's proceed to the components of supply chain management, and these are plan, source, make, deliver, and return. So, first, plan. This is the strategic portion of supply chain management. You need a strategy for managing all the resources that go toward the meeting of the customer demand for your product and services. Second will be source. Choose the suppliers that will deliver the goods and services you need to create your product. Develop a set of pricing, delivery, and payment processes with suppliers, and create metrics for monitoring and improving the relationships. Third is make. This is the manufacturing step. Schedule the activities necessary for production, testing, packaging, and preparation for delivery. Next one will be deliver. This is the part that many insiders refer to as logistics. Coordinate the receipt of orders from customers, develop a network of warehouses, pick carriers to get products to customers, and set up an invoicing system to receive payments. And then the last one is return. This is the problem part of the supply chain. Create a network for receiving defective and excess products back from customers and supporting customers who have problems with delivered products. The fifth topic under the conceptual framework of performance management is customer relationship management. Let's get started. What is customer relationship management or CRM? There are as many definitions for CRM, but at its basic core, CRM or customer relationship management entails initiatives that surround the customer side of the business. An example is initiatives wrapped around the customers in an effort to increase sales, improve customer service, add market share, enhance customer loyalty, and reduce operating costs of sales and service. At its more formal definition, customer relationship management or CRM is a business strategy comprised of process, organizational, and technical change whereby a company seeks to better manage its enterprise around its customer behaviors. It entails acquiring and deploying knowledge about customers and using this information across the various customer touchpoints to increase revenue and achieve cost reduction through operational efficiencies. The adoption of customer relationship management is being fueled by a recognition that long term relationships with customers are one of the most important assets of an organization. It entails all aspects of interaction that a company has with its customer, whether it is sales or service related. CRM is often thought of as a business strategy that enables businesses to understand the customer, retain customers through better customer experience, attract new customers, win new clients and contracts, increase profitably, decrease customer management costs. So CRM is an integrated approach to identifying, acquiring, and retaining customers. By enabling organizations to manage and coordinate customer interactions across multiple channels, departments, line of business, and geographies, CRM helps organizations maximize the value of every customer interaction and drive superior corporate performance. So here's a quick glance of what CRM is all about. The complete description of how CRM functions in a company would be too complex. That is why some authors only describe basic definition and divide it into parts and their characterization. Some authors call this types of CRM, but other authors are inclined to a view that describes this as your three parts of the CRM application architecture. And these are analytical CRM, operative CRM, and collaborative CRM. So first we have analytical CRM. The purpose of analytical CRM is customer data analysis, its evaluation, modeling, and prediction of customer behavior. So in real life situation, the analytical CRM can, for example, gather all the data about customers inquiring a specific product by using data mining, what services they purchased right away, and what services they purchased eventually. It can find patterns in their behavior and propose next steps during upselling or cross selling. It can evaluate efficiency of a marketing campaign, propose prices, or even develop and propose new products. This way, analytical CRM serves as some sort of help during the decision making. Example, manuals for employees working in services concerned with how to interact or how to react to certain customers' behavior. It's like making a script. Operative CRM mainly supports the actual contact with customers conducted by front office workers and general automation of business processes, including sales of products, services, and marketing. All communication with a customer is tracked and stored in the database, and if necessary, it is effectively provided to users, and these users are our employees or workers. The advantage of this approach being the possibility to communicate with various employees using various channels, but creating the feeling that customer is being taken care of by just one person. It can also minimize the time that the worker has to spend typing the information and administrating or when the data is shared. This allows the company to increase the efficiency of their employees' work and they are also able to serve more customers. Last, we have collaborative CRM. Collaborative CRM enables all companies along the distribution channel, as well as all the departments in a company, to work together and share information about customers. This also speaks about partner relationship management. The goal of collaborative CRM is maximum sharing of relevant information acquired by all departments with a focus on increasing the quality of services provided to customers. The ultimate outcome of this process should be an increase in customers' utility and his loyalty. So at this point, it must now be clear to us why CRM is important. We are now at the last topic under the conceptual framework, which is all about customer profitability analysis. Many companies are convinced that improving corporate profitability requires more customer contact and closer customer relationships. Further, many marketing professionals have directed recent attention to increasing customer satisfaction, primarily examining the links between overall satisfaction and revenues. Meanwhile, accountants have traditionally focused on cost reduction. Customer profitability analysis attempts to bring together marketing and accounting professionals to analyze, manage, and improve customer profitability. Companies are attempting to understand better and to satisfy present and future customer demands. However, the goal is to increase customer satisfaction profitably. Customer profitability analysis has become an important new management accounting tool based on recognition that each customer is different and that each peso of revenue does not contribute equally to the firm's profitability. So, customers actually utilize company resources differently. Thus, customer costs vary from one cost of the customer to another. So, the following issues should be considered when analyzing customer profitability. First is how to develop reliable customer revenue and customer cost information, and how to recognize future downstream costs of customers, how to incorporate a multi period horizon in the analysis, and lastly, how to recognize different drivers of customer costs. So this actually requires a broader examination of the costs associated with customer service. So for example, post-sale customer service costs must be included in any analysis of customer costs. Post-sale meaning after sale or after the rendition of the service. Some customers require substantially more post-sale service than others, correct? In addition, future environmental liabilities related to the sales of current products are considered as additional downstream costs that must also be included in our customer profitability analysis. With management's increased focus on customers, this analysis can provide forward looking information about individual customers and customer segments, and more broadly examine both the revenues and costs related to customer transactions. Revenues can vary among customers due to variations in volume levels and differences in price structures, products, and services. Now, there are many costs that are often hidden with production, support, marketing, and general administrative areas. So, to better understand customer profitability, these costs should be examined and assigned appropriately using the ABC method or activity based costing method. I'm sure you've heard of ABC before. So, let's have an example. This table shows data on four customers. Have customer A, customer B, customer C, and customer D. So to help you recall, ABC or activity-based costing uses activities as cost drivers. Then to compute for the total cost, we need to multiply the cost per activity to the volume of the activity. So here we have the following data. The revenues that we earned for a particular customer in here. So we were able to earn 120,000 of revenues from customer A, 240,000 worth of revenues from B, 100,000 from C, and 140,000 from D. And then the number of sales visits that we did in order to close these sales, we have 3 for customer A, 3 for customer B, 5 for C, and 10 visits for customer D. And then to earn this much of revenues, here are the number of purchase orders. We have received 20 purchase orders from A, 60 from B, 50 from C, and 40 from D. Number of deliveries. So if you can see here, we have sold 60,000 units to A, and then we did around 12 deliveries for all the 60,000 units. So 12 deliveries for customer A, 16 deliveries for B, 25 for C, and 15 for D. Kilometers per journey, we have 20 kilometers per journey for customer A, 35 for customer B, 10 for customer C, and 50 for customer D. And then we also have here number of rush deliveries. There are no rush deliveries for customer A. There are 3 rush deliveries for customer B, 1 for C, and 2 for D. And then the cost per activities are the following. So per visit, the cost is 2,100. That is per visit. And then for order placing, we have 600 pesos per order. Product handling, we have zero point 0.3 per item. Normal delivery cost, we have 20 per kilometer. And then for rush delivery cost, we have an additional 2,000 pesos per delivery. All we need to do is to multiply our cost per activity here to the activity itself. The activities here, the number of sales visits, purchase orders, deliveries, and so on, these are our activities and these are our cost drivers. So we need to multiply the cost per activity to how many activities for I mean how many repetitions for that certain activity. So, for example, for number of sales visits, we have 3 for customer A. So just multiply 3 times 2,100 per visit. And then for order placing, we have 600 per order. So that's 20 times 600. Product handling, that is zero point 0.3 per item. And we all know that we sold 60,000 units to A. So just multiply 60,000 times the cost per item. That is for product handling. And then normal delivery cost, we have 20 per kilometer. So we have 12 deliveries per A, and then kilometers per journey is 20. So just multiply 12 deliveries times 20 kilometers to arrive at your total kilometers, and then multiply it to your cost per kilometer, which is 20 per kilometer. And then 2,000 per delivery. This is for rush delivery. There are no rush deliveries for A, but for the rest of the customers, we have rush deliveries. So just multiply it. For example, for customer B, we have 3 rush deliveries. So just multiply it to the cost per rush delivery. That is 2,000. So you may pause this video so you can make the table in your notes and then try to answer and try to compute the total cost for all 4 customers. And then just play the video again when you are ready. So you should be able to arrive at the following amounts. So the revenues, just copy the revenues, and then these are the costs per total costs for all activities. And then to arrive at your operating profit, just deduct all costs from revenues. So the operating profit for customer A is 78,900, and then to compute for the percentage, just use the formula operating profit divided by revenues. So what did we learn here? If you simply look at how much revenues we earn from a particular customer, we might say that customer B is the most valuable customer because we were able to earn 240,000 pesos from customer B. However, after doing customer profitability analysis using activity-based costing, we found out that it was actually A, customer A, right? Who is more profitable to us because the profit percentage that we had for customer A is 66%, way higher than customer B. Also, we can see that customer C and D yielded a very low profit percentage. There is no point in serving these customers as the situation stands, but it will also be very foolish for us to refuse to serve them. Instead, what we should do is that it may be better to turn them into profitable customers if this is possible. Example, introducing a third party wholesaler into the supply chain, which might result in the improvement of the product range and service to the small customers who were not so profitable to the firm. So, to recap, we have covered the last 3 topics of the conceptual framework. Again, the first 3 topics were already discussed in part 1 of this 2-part video. Thanks for listening. Bye.